This is level 1 of the CFA program, the topic on financial statement analysis and the reading on non-current or long-term liabilities. Let me just remind you that our focus here today is going to be on the middle right-hand side of the balance sheet. So forget about all that stuff on the top right of the balance sheet, things like accounts payable and wages payable and all those other payables that are due within a year. We want those long-term payables. So these are notes payable, these are bonds payable, these are leases payable, and these are pension obligations. And so that's really our focus, and you'll see that as we go through this slide of LOSs. So look at those top handful of LOSs: measurement of bonds, bond discounts and premiums, covenants and disclosures. Then we'll talk about leasing, and then at the very bottom we'll go ahead and talk about defined contribution and defined benefit plans, and then as always we'll go ahead and look at some ratios. Now the good news is that you've seen these leverage ratios before, so this will be a little bit of a review. Let's start with a good definition: non-current liability. I think I just said this a minute ago. If current liabilities represent a probable sacrifice of economic benefit in periods of less than a year, then a non-current liability then has to be greater than 1 year. So there we go: bonds payable, notes payable, and leases. Let's go ahead and look at a corporation's issuance of bonds. This is what I tell my students all the time, and I say these regularly in these recordings. What do we know? We know that corporations issue bonds all the time, and they issue shares of stock all the time. And so we're focused just on the fixed income portion of the right-hand side of the balance sheet. And so notice what that first sentence tells us. It refers to a contractual promise. And so this is how I explain it to my students. When a company issues bonds, it makes an explicit promise. And that promise sounds like, I promise to pay interest and I promise to pay principal. And that is a legal and binding contract. So that's where that word contractual comes in. Now, of course, when we issue the bonds, we make these promises to pay in the future, probably regular interest payments, and then a final maturity payment of $1,000 per bond when the bond matures. But we receive cash immediately. We call these the proceeds of a bond issue. And of course, corporations use the proceeds of a bond issue for many purposes. The primary purpose is to use those proceeds to invest in positive net present value projects. We'll talk at length about that when we get into the capital budgeting readings. But of course, corporations can issue bonds for a variety of other purposes. They could issue a bond to pay a dividend, although that's probably not too terribly recommended. They could issue a bond to take over another company. That's probably not a bad idea. And there are lots and lots of other reasons to issue bonds. And so let's get some definitions here. Face value, maturity value, par value, principal amount, these pretty much all mean the same thing. The amount of cash payable to bondholders when the bond matures. Now remember, corporations issue bonds in the hundreds of millions, if not billions of dollars. But the corporation is not going to issue a bond to one person out there or one organization. So they chop the bond issue up into smaller, more palatable pieces. And those pieces are almost always $1,000. So that's why you'll see as we go through this slide deck that bond face values are $1,000. That's pretty much a convention. And then the promise to pay periodic interest. Now, when we have a fixed income security, we typically don't call it an interest payment. We call it a coupon payment. Now, this is what corporations try to do. They try to pick a coupon payment that is going to match the market rate of interest. We call that the yield to maturity on the bond. I mean, it makes sense that if the market rate of interest right now is 10%, and I'm Jim's company, that I'm going to issue a bond and I'm going to pay a coupon rate of 10%. I want to match the yield to maturity, which is also known as the market rate, with the coupon rate on the bond. Now, when that happens, If the coupon rate and the market rate are the same number, whether it's 8% and 8% or 12% and 12%, the price of the bond will be equal to its face value. That price will be $1,000. Now, over time, the market rate of interest changes, and this fixed coupon rate doesn't change. So, you have the fixed payment like this, and you have the market rate going up and down, and the bond price is going to depend on both of those factors. But as the market rate changes, can I say it this way? As the yield to maturity changes, the bond price will change. And so this is what we have right here. Look in the very middle. Coupon rate exceeds the market rate. If the coupon rate exceeds the market rate, that must mean that market rates have fallen over time, which means the bond will sell for more than $1,000. So there we go. Bonds selling at a premium, that's when the coupon rate exceeds the market rate. And then, of course, the flip side of that is if the coupon rate is less than the market rate, then the bond will sell at a discount. And so think about this. If the coupon rate is 8% and the yield to maturity of the market rate goes up to, let's say, 10% or 11%, bond price has to fall because these new bondholders that come in who are going to buy the bond, they want to get 11% or 12%, whatever I said a minute ago, and they can't get it if they pay a higher price, so the price has to fall. All right, so how about this LOS? Initial recognition, initial measurement, and subsequent measurement of bonds. All right, so let's go ahead and take a look at this from a comprehensive financial statement viewpoint. So think about this. I'm Jim's company, right? And I issue $1 billion in bonds, and I make this explicit promise. I promise to pay interest. I promise to pay principal. But what I get? Well, I get a bunch of cash, right? I have this cash inflow of $1 billion. So that's going to go under the financing cash flow on our statement of cash flows. And then on the balance sheet, I'm going to recognize a bonds payable, which is probably going to be somewhere around the sales proceeds. What did I say a minute ago? That's $1 billion. So how are we going to account for these? We need to identify the key features of the bond. That's the coupon rate, the time to maturity, and the yield to maturity. And the reading emphasizes the terminology, the market interest rate. So we're going to determine those future cash outflows, and then we're going to discount those future cash flows, and that's going to give us the bond's value and probably give us a good indication of what those bond sales proceeds might be. So let me go ahead and repeat this because this is super important for the rest of level 1, level 2, level 3. You will always be asked to compute the price of a bond, and here's a great lesson to learn here today. The price of any financial security, the price of a fixed income security, the price of a bond, is nothing more than the present value of the explicit promise. What was that explicit promise? I promised to pay interest. We call that a coupon payment here in fixed income securities. I promised to pay principal. So all we're going to do is take the present value of an ordinary annuity and the present value of a future value, and we're going to sum those, and we're going to call that the value or the price of a bond. Now, both the international group and the U.S. group views the premium or discount. Let me go back here. What did I say just a moment ago? That firms, they like to try to issue a bond so that they receive $1,000, right? The market rate matches the coupon rate, but there's some time lag, and there are possibility of great changes in economic conditions, so firms are rarely able to do this. So firms tend to issue bonds either at premiums or discounts. And so those premiums and discounts, they have to be amortized. And so both the U.S. and the international group, they favor the effective interest rate method to amortize the bond premium or the bond discount. And I'll show you an example of that here in just a second. So look at amortization there in the middle. So what we're going to do when we amortize the discount, we're going to take the interest expense and we're going to subtract out the cash payment, the cash interest payment. Then for the amortization of the premium, we're going to reverse that. We're going to take the cash interest payment and we're going to subtract out the interest expense. And you'll see exactly what I mean here in just a second. Here we are. So let's go ahead. We've got a bond, $1,000 face value. Boy, didn't I tell you that earlier? And by the way, I don't ever give that to my students on exams. And so the CFA Institute, they may or may not give you that $1,000. So if they don't give it to you, you know it has to be $1,000. All right, 5 years to maturity, 10% annual coupon rate. And let's suppose the market rate at issuance is 12%. Just remember that market rate of interest, you can also use the term yield to maturity. So let's go through the columns here, and this will be pretty simple, hopefully. And if you want to get out your calculator, you can. And I'll show you how to hit those buttons here in just a second. So down the left-hand column, we have, years 1, 2, 3, 4, and 5, right? This is a 5-year bond. There's our coupon payment. Notice we call it an interest payment in the purple. So we take the 10% annual coupon rate, multiply that by the $1,000 face value, so 10% of 1,000. There's the fixed coupon payment, so that's $100 down that column. And then we're going to take the present value at a 12%, I'm going to say it here now, the yield to maturity on that bond. Of course, it's a market rate of interest. And so if you quickly want to get out your calculator and just take 100 and divide by 1.12, you'll get that 89.29. And then you can take the 100 and divide by 1.12 squared, and you can do that all the way to the bottom. And if you sum the present value of those coupon payments, you're going to get $360. I think we left off the pennies there, so we're doing a little bit of rounding. Now look at the next column. Notice that this is year 5, and there's that face value payment, that maturity value payment of $1,000, and its present value at 12% is $568. So what we're doing here is all we're trying to do is determine what is the price of the bond so that we can determine the sales proceeds of the bond. And notice at the bottom, if we take the 360 and we add the 568, we get total present value. And this is what I want you to do. If you're taking notes along with this, I want you to say that 928, circle that 928 and say that is the price of the bond. The price of any bond is the present value of the interest payments, we'll call them coupon payments, and the principal payment of $1,000. Now, of course, on the exam, if the CFA Institute asks you to determine the proceeds of this particular bond issue, you're not going to do any of that stuff because that takes you way too long. What you're going to do is you're going to get out your financial calculator and you're going to hit those buttons over on the right-hand side. So do you want to do that with me real quick? So remember, you're entering the number first. So you're going to do 5 and then hit N, and then 12. The calculators want you to do this in percent form, so you're going to do 12 and hit I. Now, you might have the TI calculator, which I think has the I/Y button on it, so 12, then I/Y, and then 100, hit your PMT button. And by the way, that PMT button, that really is the ordinary annuity button. Yeah, look at those interest payments, 100, 100, 100, 100. That's a 5-year ordinary annuity, so we just hit the PMT button. And then at maturity, after 5 years, we're getting the 1,000. So enter 1,000, then hit future value. And then those of you who have the HP calculator, all you have to do is hit present value. You'll get 928. Those of you who have the Texas Instruments, you have to hit that CPT button, the compute button up on the top left. That's one of the penalties of using the Texas Instruments calculator. And I say that to my students all the time. But there are some benefits to using the TI. We'll get into that some other day. All right, so look at the bullet points down there at the bottom. At issuance, cash increases by $928, but bonds payable increases by $1,000 because, what did I say earlier? An explicit promise. I promised to pay that $1,000 at maturity. So we have bonds payable of $1,000 and we have cash of $928. Well, what's the difference? The difference is $72, and that's the discount on the bond, which has to be amortized. All right, so what does that LOS say? Calculate interest expense and then interest payments and then the amortization. So let's go ahead and do the amortization here. All right, you ready for this table? All right, so down the left-hand column, there are the years, right? 1, 2, 3, 4, and 5. So there's the carrying amount of our bond. Here, let me go back here real quick. We just did that by all those calculations, 928. So if we take 12% of that 928, we get 111. So there's our interest expense that we report on our financial statement, because we're taking 12% of the amount that we borrowed, right? We only borrowed 928. The interest payment, our coupon payment, right? That's 100. So if we take the difference of those two, 111 minus 100, we get $11. And so the carrying amount of by the end of the year is going to be the 928 plus the 11, and that gets us to 932. So notice what's happening on this right-hand column. We started with 928, we ended with 939, which was just a difference between interest expense and our coupon payment. And so that carrying amount, that has to move up to, well, you can see at the bottom there, it has to move up to $1,000, because in 5 years, we're going to owe $1,000. And so this is what the amortization of the discount means, is that we are pumping up, we are swelling, we're filling the bathtub up, right? Our bathtub was only 92.8% filled, so we have to amortize that to fill it up to 100%. And so I'll leave you candidates to work through the math of the rest of each of these carrying amounts and then the discount, because what does that LOS say? Describe and calculate. Okay, so you have to calculate that. And so, boy, wouldn't it be awful if the CFA Institute would say, here's a 75-year bond. What is the amortization of the discount in year 64? Oh my gosh, so you'd have to do a table that goes like this and goes like that. I would never ask a question like that, and I'm pretty sure the Institute would never ask a question like that. Excuse me. But it's clearly reasonable to ask you to do this over a 3 or a 4 or a 5 year period, probably not 10 years or 20 years. Well, let's suppose that just the opposite happens. Let's suppose that we issue a bond at a premium. So we have the same conditions, 10% coupon rate, 5-year bond, but let's suppose that the yield to maturity, or the market rate of interest, is only 8%. Oh my gosh, so what did we say in a couple of slides ago? If the coupon rate is greater than the market rate, well, that must mean that the bond price had to have gone up. Oh, of course. So I'm not going to take you through this again. You can pause the video if you want. Down the left-hand column, just quickly, there's our years 1, 2, 3, 4, and 5. There's our coupon payment of $100 again, and there's our present value of our interest payment at now 8%, right? Let me just go back here. Here it was at 12%. Now here it is at 8%. And then there's the face value payment, et cetera, et cetera. So you do $399 and the $681. So there's the price of the bond of $1080. And I think it's worth taking a moment or two. Get out your financial calculator again. Now look, your calculator remembers all those things. So remember, you have an N equals 5, you have a payment of 100, you have a future value of 1,000 in there. All you really need to do is hit 8 and then I, and then hit the PV button, and you'll get $1,080. Now, before I go on and show you this next slide, which is just kind of a repeat of what we did earlier, I want to go back here and make a comment. You might be asking yourself the question, Jim, explain to me why this bond that has a 10% coupon and a 12% yield to maturity, explain to me, kind of in regular common sense terms, why this bond sells at a discount. I've just shown you the mathematics of it, but I want to give you a little bit of a commonsensical interpretation. All right, here I am. I'm Jim, my company. I have promised to pay you a 10% annual coupon rate. And you look at me and you say, you know what, Jim, I'm not happy about that. I don't like that 10%. There's more risk out there. There's more uncertainty out there. Interest rates in the economy have gone up. I demand 12%. Well, the question then becomes, how can you, as the bondholder, squeeze 12% out of a financial security that's only paying 10%? And hopefully you're following along with my lecture. And the obvious answer is, well, you can squeeze an extra 2% out of it by paying less for the bond. You're not going to pay $1,000 for the bond because your yield to maturity is not 10%. You're only going to pay 9.28. You're squeezing an extra 2% by paying less for the bond. And that holds true here. All right, let's go back to my example. I'm Jim. I issue a bond that has a coupon rate of 10%. But you guys, you're my bondholders. You say, you know what? We don't like that. Risk is less. Uncertainty is less. Interest rates in the economy have fallen. You're only going to charge me 8%. And I say, wait a minute. Whoa. I say, I'm doing you a favor. I'm paying you 10% and you're only requiring 8%. So you better reach into your pockets and pay me more. I'm doing you a favor. You pay me a premium. So I want you to think about the relationship between the issuing company and the bondholders when you think about how to interpret a bond that sells at a discount or a bond that sells at a premium. All right, so I'll let you guys go through the mathematics here, but this is just the opposite of what we just did. Notice the carrying amount of this bond, $1,080, right? We just did that a moment ago. And so we have to amortize that premium. So what we need to do is that we need to shrink the water in the tub. We have the tub is overflowing. Using my analogy from before, the tub is overflowing, and so we have to go in and get our bucket and scoop it out. I don't know if that's a good analogy or not, but notice at the end we have to get down to our $1,000 because after 5 years, that's all we owe. So let me go back and just make sure you understand the difference between these two illustrations. Here at a bond that is issued at a discount, the carrying amount is going to rise to the $1,000 maturity value of the bond. Here, the bond that's selling at a premium or issued at a premium, that's going to fall down to $1,000. How about derecognition of debt? Well, let's suppose that we're a company like Walt Disney or Coca-Cola. They've issued 100-year bonds or 75-year bonds. And so let's suppose we're all the bond holders. So what do we know? We know, and let's just suppose that coupon rate was 10%. We know that we're going to get $100 every year. Now, one thing that's important, that's not important for this reading, but we'll learn this in future readings, is that most bonds pay interest semi-annually. But let's just suppose that this Coca-Cola bond pays $100 every year. We know that we can get $100. We're going to get $100 as the bondholder every year for 75 years. Well, sometime during the course of that 75 years, Coca-Cola or Disney or any of these companies that issue long-term bonds, or even companies that issue 30-year bonds or 20-year bonds, they may decide that they don't want those bonds outstanding anymore. So they might just go and repurchase them. And so a lot of times what companies will do is they'll go out and buy some of their bonds, just in the open market. And as they repurchase these bonds, then the carrying amount has to be reduced by the bond redemption, and those bond payables then gets reduced as well. Now, one thing that the reading does not emphasize, but you'll learn as we go through level 1, is that lots of these bonds are callable, which means the company can force the bondholders to sell those bonds back to the company. Maybe some of the bonds, maybe a majority of the bonds. Oftentimes it's all of the bonds. So notice what's happening. That's called derecognition of debt. It's not like the derecognition of an asset that we talked about in a previous reading. This is a financial security. And so what's happening is really you're just shrinking it. So just think about that. Now, of course, depending on whether the bond was issued at a premium or a discount, or depending on what the current relationship is between the coupon rate and the yield to maturity on the bond, there might be a gain or a loss. And so this is going to have to show up over on the income statement. Notice our last arrow point there, in a separate line item whenever the amount is material. Describe the role of covenants. All right, so let's go back to this thing here. I'm Jim, I'm issuing a bond, and you guys are all my bond holders. and you lend me $1 billion. And after all, when you lend me $1 billion, you're trusting me, right? I'm an executive. I'm a good steward of your capital. Now the question is, do you fully trust me? I mean, what could I do with that? I could take some of that money and I could say, you know what? I live way over there. I want to have a helicopter to and from work every day. So I buy a company helicopter so that I can get back and forth to my home a lot more conveniently than driving, and facing traffic and, all the bad things that happen out on the highways. And so as protection, you guys as bondholders, you have a list of things that you say, Jim, you can't do. All right, Jim, when you issue this bond, you can't buy a helicopter. Jim, when you issue this bond, you can't pay a dividend. Ooh, now we're getting somewhere. Hey, Jim, when you issue this bond, we want you to invest it in wealth increasing projects. All right. And so these covenants are usually broken down into positive covenants and negative covenants, although the reading uses the term affirmative covenants. So what are these? Restrict the borrower's activities by requiring that certain actions be undertaken. So a lot of those certain actions be undertaken relate to ratios. Now we'll do some leverage ratios at the end of this slide deck, but you should remember some of those leverage ratios like a debt to equity ratio. We've done that before. Let's suppose that our debt to equity ratio is 1. And so it might be something like, look, Jim, you're only allowed to do something if, in fact, that leverage ratio is below 1 or below 50% or whatever it is. And then negative covenants are just the opposite. You are not allowed to do things. So, dear Jim, you're not allowed to buy a helicopter. Dear Jim, you're not allowed to make a dividend payment. Dear Jim, you're not allowed to call some junior debt out there or subordinated debt. Dear Jim, you're not allowed to make a dividend payment unless all these ratios are met. So this is kind of a general LOS here in this reading. So just remember the difference between positivity and negativity there. Yeah, what happens if I'm Jim and I issue the bond and I violate one of these debt covenants? And so this is why we have the court system, right? You can take me to a court and there'll be a judge, and the judge will say something like, you know what, Jim, you're guilty, and then we'll try to figure out what to do. So look at these. I mean, I could waive the covenant. I could make a payment. I could say, you know what, I'm paying you a 10% coupon. How about if I make it up to you by paying a 10.5% coupon in the future? Or we can renegotiate, or the judge could say, hey, Jim, you know what? You're a loser. Sell these assets over here and pay off all of those bondholders. I will say this. I tell my students all the time to regularly read the Wall Street Journal, and I have repeated that in these recordings over the years, especially in level 1. And when you read the Wall Street Journal, you'll read about positivity and negativity, but I cannot remember, I'm sure there has been a case, but I can't remember where the borrower violated a covenant and the terms were renegotiated, so there was an immediate repayment of debt. Now, after I say that, I'm guessing that some of you are aware of those things, so you can always reach back out to us and tell us about it. All right, let's go ahead and ask the question, what does this have to do with financial statements here? So non-current liabilities usually includes a single line item that says, bonds payable, long-term debt. But now remember what I said earlier, and this is why I said it earlier, that lots of bonds pay interest twice a year. So if we have a coupon payment that is due in 1 month or 3 months or 5 months, that's known as the current portion of long-term debt. And that next coupon payment then slips up into current liabilities. And as you can imagine, we can have lots of notes and disclosures about these kinds of things. And I can assure you that it's not too terribly exciting reading. But what you do when you get in these notes and disclosures is you kind of get an idea of what the executives were thinking when they issued the bond. Now notice that last arrow point there, more complex debt contracts. So there are convertible bonds out there, there are callable bonds out there, there are puttable bonds out there, there are bonds that are able to be swapped or exchanged, There are warrants. There are other kinds of embedded options in there. So, of course, those are important disclosures. All right, so that's part of the long-term portion of the right-hand side of the balance sheet. Let's go down one more item and call this leasing. And here's the example that I give students all the time about leasing. And the airlines are great examples of leases. So let's suppose that I'm Jim's airline company and I don't have any airplanes and I'm starting my company. And so what am I going to do? Am I going to go out and buy a Boeing 747? What can those things cost these days? $400 million, $500 million. I mean, whatever that price is, I probably can't afford that as Jim's new airline. But what I could do is I could probably lease that airplane from Boeing. What could that annual payment be? Oh, I don't know. $200,000, $250,000. I mean, whatever that is. And so that's what we're going to do. Right? A lease is a contract between the owner of the asset and the one who is seeking to use the asset. So what happens is that the lease is actually, it's a legal and binding contract. There's exchange for the right to use the asset with a promise of making periodic lease payments. So I want to stop you right here. Think about this. I'm not going to go back in the slide deck, but think about that column where we had that fixed coupon payment of $100, right? Those were periodic interest payments. Well, now all I'm going to do is substitute the word lease in there for interest. These are periodic lease payments. So leases, they look a little bit like a bond issue, but they're not. They're not exactly, but those similarities extend to the periodic payments. All right, let's look at that LOS. Explain the motivation. So I think I just did this. So provide less costly financing, right? That makes sense. Less restrictive provisions and reduces the risk of all sorts of bad things that can happen during the lifetime of either the asset or the lease. All right, two types of leases out there. Let's go over to the right one, the operating lease. This is the lease that looks an awful lot like the rent. I'm guessing that you guys all went to college sometime and during your senior year or maybe during graduate school, you got out of the dorms and you rented an apartment and so you signed a lease. And so this is what an operating lease is. You just kind of rent. What does that tell us? Does not transfer substantially all the risk and rewards incidents to ownership. So you lived in this apartment, but you didn't really own it. And so you didn't have all of the risks and rewards, but if the electricity went out or the commode didn't flush, you still had some risks. Now, you probably didn't have to pay for all this thing to be fixed, but you still had to do without electricity or without water or whatever it was. Now, the more interesting one, of course, is the finance lease. Some people call it the capital lease. Those two terms are interchangeable, but here, look at the bottom there. So finance lease is the international term. Capital lease is the U.S. term. I don't know if the CFA Institute would do that on the exam, call it a finance lease, and then want you to do the international standards or the capital lease and want you to do the U.S. standards, but you can be prepared for that. So look at that definition up there. Substantially transfers all the risks and rewards incident to the ownership of the asset. So it's kind of like you have bought the asset, but you haven't really bought the asset. But you get all of the benefits. And so on the financial statements, you have to treat it as if you own the asset. So let's take a look from the lessee's perspective. So here we are. We've got this finance lease. So it shows up as a right of use asset. We sign a lease obligation. We can depreciate the asset, and then we are going to reduce the lease obligation. That's kind of like amortization there. On the income statement, we're going to report interest expense and we're going to report depreciation. And then this is probably important here. So look at the very top there. Reduction of the lease obligation is a financing cash outflow, but the interest expense is either operating or financing under the international standards, but it's an operating cash flow under US GAAP. And I'm pretty sure if you go back and read the cash flow or watch my cash flow recording, you'll see that we have some table in there what tells you about the finance lease. And then for the operating lease, this is super simple. We just report the lease expense, and then it's an operating cash flow. Here's just a quick example. We've been looking at some of the Nike financial statements. So their operating leases through 2022. Boy, so what do we have? What is that? $4 billion out there for operating leases, and capital leases. What is that? 370 million of those that are outstanding. And so, what will you say of Nike? That they have far more operating leases than they do capital leases. And then look up at the top. This will probably give you a sense of what Nike is leasing: retail store space, distribution and warehouse facilities, office space, equipment, and other non-real estate assets. There you go. 1 to 17 years. So what do? They go back from 2022 to 2018. So what is that? 5 years, but they have 17 years. Now, how about from the lessor's perspective? All right, so the finance lease, what we're interested in is taking present value. So we're going to compute that present value, and when the present value of those lease payments exceeds the carrying amount of the leased asset, then we have this definition. It's called a sales type lease under the US GAAP. And so what we're going to do, we're going to recognize this lease receivable. We're going to report profit on the sale, and we're going to report interest revenue on the income statement, and then over on the cash flow statement. Remember that the international standards allow us to do this both under either operating or investing, but it's an operating cash flow under US GAAP. And then under the operating lease, what are we doing? We're just retaining the assets, so we're going to report net income and depreciation, and that's operating cash inflow. All right, so what do? We did the bonds payable, we did the leases, and now we're down into this last section, and we're going to say to ourselves, okay, we've promised our employees that after they retire, we're going to pay them a bunch of money. So this is called pension obligations. And I'm guessing you know this. You probably don't need me to tell you the difference between a defined contribution plan, which is what I have through my college, right? I contribute every paycheck, and the college contributes every paycheck. And what I could do is I could take that money and I could just go to Las Vegas and I could bet it at the roulette wheel every month, let's say. And if I lost every month, forever and ever, and on the day I retired, I would have $0 in my defined contribution pension plan. So notice the amount of future benefits to employee depends on the investment performance of the plan's assets. Now, of course, it's not legal for me to take this out and go to Las Vegas, although I guess I could withdraw some of it and pay a penalty and probably pay some taxes on it, and that probably wouldn't be very smart. So the contribution from the employer, that amount is defined each period. And so think about this. The defined contribution plan is really my plan as the employee. And the employer, whether it's my college or university, or whether it's Nike or Under Armour or whoever it is, it's their job to kind of keep track of the stuff. Somehow they keep track of it. Not necessarily on the financial statements, but somewhere they keep track of it. But here's where we get super interesting, the defined benefit pension plan. This is where the benefit is particularly defined. And so if I were under a defined benefit plan, my formula might sound something like this. All right, Jim, let's take your last 5 years worth of your salary, and let's take the average of those and let's multiply it by 150%. And that's what you're going to get every year when you retire. Of course, that's a super, super generous plan. Contributions from the employer, then, that depends on a variety of factors, not just current period estimates, but investment performance of the asset. And then inside of that, the selection of those assets. All right, so let's take a look at what shows up on the financial statements. We want to know about this. So defined contribution, balance sheet, there's nothing there. I said that. But on the income statement right there, they're contributing to my fund, so they got to show me that. Footnote, they'll probably say something like, oh yeah, we put $5 in Jim's account last month, something like that. But the defined benefit plan, on the other hand, look at the footnotes over on the bottom right. This is super extensive because, I mean, think about it. A company like Nike, how many employees can they have? 40,000, 60,000, 100,000, however many it has. If it had a defined benefit plan, it would have to keep track of all 100,000 of those employees. They'd need to know the age, the number of years until they are expected to retire, and then throw in their life insurance and some other factors. And so you can imagine that those footnotes are extensive. On the income statement, there are periodic expenses because there are contributions into the fund, plus there are outflows that go to currently retired employees. Now on the balance sheet, we'll have this net funded position. And so what would we like to have? We take the present value of all of those future pension obligations. Let's suppose we get 100. And we take a look at the value of the assets. What are we doing? We're investing in stocks and bonds. If 100 equals 100, then we have a fully funded defined benefit plan. I'll go ahead and ask a rhetorical question out there. How many fully funded plans are out there? I don't know. 0. It comes to mind to me. But, of course, sometimes there's a surplus and sometimes there is a deficit. And so these net funded positions, look at the parentheses, fair value of the plan, assets minus the present value of its projected benefit obligation. And we'll do some really good math at some other reading, but not this one. Let's go ahead and finish up with some ratios that you already know. So leverage ratios, those are balance sheet items. Coverage ratios represent the relationship between what's going in and what's going out, or what's going out and what we owe. And so let's take a look at some of these here. Debt to assets, we've done that before. Debt to capital, debt to equity, financial leverage ratio, interest coverage, fixed charge coverage. So let's go ahead and take a look at a quick example. So here's some numbers. December 31st, we've got their total assets. We've got some income statement stuff. There's a lease payment. And so I'll go ahead and let you guys pause the video or take a picture of this, work through the math. It's pretty simple stuff going from that previous slide to this slide. But I'll go ahead and just make one or two comments here. Look at the debt to asset ratio. What do we have? For every dollar in assets, we've issued 32.8 cents in total debt. Now this is total debt, not just long-term debt, which is what we've been talking about, but long-term and current debt. And that's 32%, which means, of course, that means is that, boy, am I smart enough to do that? What does that mean? 67.2% comes from equity. And that takes us through these learning outcome statements. And so think about this. You got the bonds payable, you got the leases payable, and then you got the pensions payable. So this really makes up the three elements of this reading. Clearly, the majority of the reading is focused on the bonds, and then it's focused on leases, and then it's focused on the pensions. But I would be able to do and calculate and interpret all of those ratios. So here's my advice. As we finish, the financial statement discussion here, if I were you, and this is what I did when I was, and remember, I went through this 20 years ago when I took level 1, is that I had a big index card and I had all of the financial ratios. I had their formulas and I used to carry it around. And, lots of them I just knew because I teach, but some of them, like when you get to like the fixed charge coverage ratios, you got to do operating income plus the lease payments. And then, interest payments and lease. I typically don't teach that in class. And so for those of you who are not professors, do a good job of memorizing all these things. So, hey, enjoy the day. It's a beautiful sunny day here in the eastern part of the United States. Enjoy it. Good luck studying, and thank you for watching.